Okay. All right. So thanks everyone for your patience there and welcome. Thanks for joining today's webinar in the Sustainability and Affordable Housing Lender Learning Network webinar series. Our topic today is how to use the portfolio level approach to finance solar across affordable multifamily housing properties. So exciting topic today. We have a really awesome lineup of speakers. Speaking now is Bettina Burgu. I'm with Soln and the Energy Efficiency for All project. We have Jared Lang from NHT-Enterprise with us, Esther Toporowski from Enterprise, and also Chris Jed from Denver Housing Authority. We're going to hear from them first, some really great presentations, and then we will hopefully have a robust Q&A. So as a reminder, just insert your questions into the questions box there, and we will get to those after the presentations. This webinar is being recorded, and the slides, in addition to the recording, will be posted online afterward. So just a little bit of background before we get started. As I mentioned, I'm part of the Energy Efficiency for All project, which is a partnership between the Energy Foundation, National Housing Trust, NRDC, who I'm with, and Elevate Energy. We're on the ground in 13 states, and with the overall objective to increase energy efficiency in affordable multifamily housing. And you can see our vision there. One part of the larger Energy Efficiency for All work is to work with the lending community to support strategies that align energy efficiency resources, such as utility incentives that we fight hard for, with the affordable housing financing process. So one of the strategies that we're pursuing is the launch of this Sustainability in Affordable Housing Lender Learning Network. You can see our group's vision and mission there. If you've attended one of our other webinars, then you've heard those before. What we are really trying to do is have a knowledge sharing and networking platform for folks such as you out there who are either currently lending to energy efficiency and affordable housing or are interested in learning how to do so. So we have webinars such as these. We are putting together a financing program and transaction database currently. And we also have, we are attending in-person events where we can get together. Our advisory group is consisting of the organizations listed there on the screen. And today, I mentioned we have some online resources. We have actually launched our Soln Resource Hub and a few other pages. So you can see the URL there. energyefficiencyforall.soln will bring you to a page about us, so you can see what the opportunities to engage are, direct others to join our mailing list, as well as access our new resource hub. And what this is meant to be is really a central repository for information on how to finance efficiency upgrades in multifamily properties. It's really meant to be actionable. It has all sorts of toolkits and webinars and handbooks that can really give, like I said, actionable information for lenders and allies out there. All the resources have been recommended by our advisory group and by members of the network. So if you go to the hub, then you'll see a space where you can actually recommend resources and contribute to it in addition to accessing it. So I hope that you do that. Before I turn it over to Jared, I'm actually going to launch a poll to get a little bit of a feel of who is with us today. So you should be seeing a poll there asking what kind of organization you're affiliated with. I see we're nearly at everybody voting, so I'll give it just a couple more seconds. Are you guys seeing the poll results?
Yes.
Yeah, okay. Okay, I'm actually not seeing it on my screen, sorry, but I am seeing in the dashboard here that we have the majority from lenders, and with the second second most from the other category, and the least number of folks from the affordable houser, developer, or owner category. So Jared, Chris, and Esther, that's interesting for you to take into your presentations.
Absolutely.
Yeah. Now we're going to do one more. I can get to it. Oh, no. All right. Now you should be seeing their second poll, just asking how familiar are you with deploying solar across a multifamily affordable housing portfolio? Quite specific, so we've got a range of answers there. In just a few more seconds, we're almost at everybody. All right. Okay, so this is really interesting. We've got, again, our speakers, take note, we've got 33% of folks that are saying not familiar, that they are here to learn, so that's good to hear. And the second most response is that they're somewhat familiar, but more on the solar side, and then third being more on the affordable housing side. So it looks like we've got folks who are totally new or come from either the solar or the affordable housing side. So, great. Okay, now, Jared, are you seeing your slides there on the screen?
Not at the moment. I'm seeing the landing page.
Oh. How about now? All righty. So yeah, go ahead, Jared. Thanks.
Sure. So I'm Jared Lang. I'm with the National Housing Trust. We're best known as a policy organization that advocates for affordable housing in DC. We also finance affordable housing through our NHT Community Development Fund, CDFI, and then we own and operate about 40 properties, mostly along the East Coast, through a development group called NHT-Enterprise. So I spend most of my time with NHT-Enterprise, and I'm the sustainability director, or whatever, assistant VP sustainability, and just building sustainability and efficiency into our existing portfolio. So next slide. Not flipping for me. Oh, there we go. Okay. So Bettina asked me to jump on this webinar and to talk a little bit about kind of like what are the structures that are out there for owning solar. What's the kind of NHT-Renewable model, the portfolio approach that we've taken, and then kind of how do you make the benefit worth the brain damage of like building solar into your project. So happy to talk through some of this stuff with you all. It looks like we have the group is of very varying levels of knowledge. So I'll try to be broad and deep. Next. So this is just a little bit on NHT-Enterprise. We own about 4,000 units. We have most of our properties, about 2/3 of them are green certified. We did the first green certification in DC, I want to say in 05, Enterprise Green Communities in 05. And we usually shoot for at least 20% in any of our like basic renovations, but sometimes we go a lot further in savings to 50% and more. We're really pushing toward that net zero goal on some of our new projects. So next. So this is, we've been working since 2014 now with Enterprise Community Partners, and I think Esther's going to talk a little bit about some of the projects that we've done from the debt side. And this is kind of our solar resume. We've done 5 separate projects. Chris is going to talk about the Denver Housing Authority solar project. We financed about, financed, and either us or one of our partners is owning about 3 megawatts of solar, about $6 million. And then we have a series of projects in our pipeline that we're developing right now. CPDC is a nonprofit housing owner in DC. Bridge Housing is in Northern California. NHT-Ingenuity is a DC project across 40 properties in the district. Riseboro CDC is in Brooklyn. It's about 50 properties in Brooklyn. NHT-Ingenuity DC2 in 2019 is going to be a community solar project across probably 5 to 7 sites, larger sites. And then the Jonathan Rose Company's portfolio is mostly in New Jersey we're focusing on. So we have some key areas based on the solar incentives, and I'll talk a little more about that later. Next. So I just wanted to cover briefly, I think before we get into sort of the portfolio approach, I think it helps to understand these are kind of the options that I've seen out there. There may be other options, but these are the ones that I'm familiar with. So, when we're talking about sort of bringing solar into an affordable housing property, I feel like we only really have 3 options. So one is either the individual property partnership that owns and operates that individual property. For the policy group on the call, the corporations, the housing corporations are separate from the properties. They actually are interested and controlling partners, but the properties operate as separate businesses. So the property could purchase the solar directly. The other option is the property partnership could bring in a third party to own and operate the solar, and to basically finance, operate the solar, and sell power to the property, and at a discount, usually some sort of discount. And then basically the property would get 2 bills. It would have a bill from the utility for like half of its power, and then a bill from the third party solar company. Sorry about that. Lastly is this NHT-Renewable model, where essentially you're setting up a company to own and operate solar across multiple property partnerships, and then the solar company is signing agreements with the properties, with each of the properties. And I'll get into that further. But I just want to quickly cover purchasing versus leasing. So go ahead. Next. So, when we're looking at, I think it's helpful to understand the benefits and then some of the challenges of, so on the purchasing side, we're talking about properties purchasing properties, partnerships purchasing the solar directly. So, if the property can afford it, they get 100% of the energy savings. It's a great environmental story. It's local energy production. And then they're not subject to the utilities price changes. So the challenges that we've seen are taking every property on a one-off basis is really difficult. The property handling the roof condition issues and structural reviews is challenging. Usually our properties are affordable, so they're lean and mean, and they don't really have a lot of upfront capital to make these solar investments. Getting all these approvals from the lenders and investors to spend the money on the solar system is difficult. And then you have to actually build the system and own and operate it. And we found that, some of the some of the housing owners do have really difficulty owning and operating one-off solar systems. So next. So with this, this is the other option here, is sort of a lease model where you bring in someone else to finance, own, and operate the system, and then you purchase power from them at a discount. So, no installation costs, no operating costs or worry. You get energy savings, but you really only end up getting usually 10 to 20, 30, maybe 30% in a really good market. So you give up a lot of the energy savings to the developer. Then you get the same kind of things: the environmental benefit, local energy production, price stability. So the challenges that we find with this are the roof condition and structural stuff doesn't go away. There's legal fees associated with bringing someone else in to own and operate this asset on your roof, and the savings is kind of small to justify, doing this review. And then some of the investors don't like third parties owning assets on top of your roof. So that can sometimes be tricky. Next. So I think this is this is a small property, and I'm going to talk a little bit about the system, but visually it helps me to see, when you purchase the solar system, if you figure out how to purchase it at the property level, you get all the savings. Your property gets all the savings, which is nice. If you lease it, you're looking at maybe, 10, 20% of the savings, and then the developer is taking the rest as profit for them and also financing the system, paying the system back. So next. So I think this is, can you go to the next one? Next. Here we go. Okay. So what we figured out a couple years ago, we looked at a couple of these models, and, we basically said to ourselves, we looked at a couple of our properties and we said, we don't really have the money to purchase this, and we don't really want to do a lease structure where we bring in a third party. And so what are our other options? Is it possible for us to take this on a portfolio scale and try to see if we can tackle all of these solar systems at one time? So, I think when you're looking at a refinancing these days, we're always looking to include solar in a renovation project and have our solar or our housing tax investor take up the solar credits. But one of the big issues that we faced kind of on a one-off basis was that we weren't able to access the solar tax credit. So we spoke to some developers and some of our investors, and they said, look, these projects one-off are too small, and we might be interested in working with you on solar tax credits, but you got to get enough credits together to make it worthwhile. So we looked across our portfolio and we said, could we do a deal like all together? Could we somehow lump these all together? So we came up with this idea of sort of like setting up a solar company that would just finance, install, and operate solar on top of our properties. And so instead of number 2 here, singing agreements, we're signing agreements between the solar company and the property partnerships to sell power. So we're effectively, instead of a third-party power agreement, it's almost like an internal power agreement. We're the controlling partner of both the property and the controlling partner of the solar company. And what this did was it helped us to get to enough scale so that we could, really make the economics worthwhile, I think. And what I mean by that is we could make an investment that felt a little bit like a real estate investment and have a real return. And we could build in a developer fee. And it's common in these deals, in these solar type deals, for the developer fee to be anywhere between 10 to 20% of the project cost. So we did a $1.3 million deal, and our developer fee was $130,000. So that was not available to us in the other options. So we really like that. So next. So this is a little bit of a visual of what we're talking about. So the housing owner in blue is both the general partner and the operating partner of all of its properties, and then it sets up a solar company which it owns to do business with the properties. So, and this is the connection between the yellow and the green is this power purchase agreement, where essentially the property gives the solar company the right to operate on the roof, and in exchange the solar company gives the property discounted power. And this solar company is of a scale where it can partner with a tax investor in a meaningful way, use the solar tax credits, bring in a debt provider. I know there's a lot of lenders on the webinar, so we would be looking to you all to come in to this solar company. So that's the general structure. There's a lot of detail that I can go into later, but next. So I think we covered this. Oh, okay, I see. Yeah, so I think it's good to think of the NHT renewable structure as kind of a hybrid. It's not necessarily a purchase at the property level, but it's not a lease from an outside third party. It's a lease. It allows the housing company to own and to purchase the solar under a separate entity and then receive the benefits. So what I like to show here in the visual is that yes, in the purchase, if it was possible, 100% of the savings would go to the property. But in this NHT renewable model, we can because we're the solar owner of the solar company now, we can afford to give more to the property. So the blue bar is bigger, and then the rest of it is us instead of an outside third party. So rather than someone sort of creating a business out of our property, we figured out a way to use the payments we're making in energy to create new income streams for our company. Next. So this was the first deal we did. We did some larger systems that were 60 kW, and then we did some smaller systems that were 15 kW. And we kind of lumped them all together. It was a total of, we also did solar thermal at the same time. We had an investor that was open to investing in PV and thermal. We did, 5 properties. It was it should be 1.3 million, and about 300 kW, 300,000 kilowatt hours a year. So this was our first foray in 2014. I think the cost of solar has come down a lot. For that much of kilowatts, you could definitely get that a lot cheaper now. Next. So I think the slides got a little bit out of order. Bettina, are you able to go back to the St. Denis? Keep going. Great, right here. So this is one of the properties that we did, and I wanted to show you this as a case study. Essentially, you know, this project would never really work on its own. We wouldn't have been able to figure this out standalone. It's 15 kW. It's a relatively small building, 32 units, 4 stories on a pretty small footprint. And we were able to do this because we rolled it in with all the other projects. 15 kW is tough to do, even on a portfolio scale, but it made sense because we had it with a lot of other bigger projects. So, you know, a 15 kW system, I think conservatively, you could say it's like $50,000. So next slide. So I think you could see here, so this is just starting from the top. This some information about the system size, the kilowatt price. But what's most important is if you look at the top section is the purchase option, if the property were to purchase it, and the bottom section is the leasing option. So this assumes that if St. Denis were to make the investment in this system, that they would be able to use the tax credit, and we wouldn't be able to. So, you know, you're looking at a little bit of a longer payback, but still an interesting investment. You know, we like to this 4-year, 5-year, 6-year payback seems like a pretty good investment and something that we'd like to do. This is in DC, so there's a combination of solar credits and savings together that are pretty strong right now in this market. So, you know, I mean, this would be good if we could access the tax credit and we had the cash, which we don't usually have either. So we looked at this, though, just from an investment and solar perspective when we were intrigued. So we were like trying to figure out if there's a way we could do this. So when you look at the lease option, you know, you might have like that investment is actually just legal fees. And then the income is like, you know, 10 to 20% of a very small system. This isn't even worthwhile for us going through the process. And I think what happens with a lot of PPAs is that people get these scopes run for them. And then the limitation of the technology is that the savings is just so small that it's not worth it. Nothing really gets done. Next. So maybe, yeah, you can jump back to, excellent, that's good. So what we did was we put St. Denis in with all the other projects, and we got to do, you know, $1.3 million in solar. We actually were big enough that we got this federal tax credit for $390,000. We partnered with a tax investor, and I can explain more later how that works. So, and then, you know, the income from this is significant, and this becomes a real deal that starts to compete with, you know, our affordable housing and makes it worthwhile to spend the time on it. So, and we look at maybe 5 to 10 year paybacks on these structures. So next slide. So these are the markets that we're excited about. DC, California has a new incentive. New Jersey has some good incentives. New York just changed an incentive to add an additional for affordable housing. Massachusetts just started a new REC program, a new incentive program. And in Colorado, we've been working on with Denver Housing Authority, and we're excited about doing more with them. So in these markets, I would say, this is kind of like our 5 to 10 year payback markets. And then next slide.
Jared, a quick clarifying question here, actually, a good one that others might be wondering. In these properties where you've done projects so far, are they master metered or sub-metered?
They're sub-metered. And I know a lot of people are, they want to get into this conversation about providing solar to the residents. And most often, the limitations of your roof space relative to the solar technology only allow you to produce a share of your common area load, even in your tenant paid buildings. So, in most of those properties that we just did, those 5, we produced probably about 75% of the common area load with the rooftops that we had.
Great, thank you.
Yeah, sure. And if there are any other questions, feel free to ask. And then these are our kind of, decent solar markets where they're sort of 10 to 20 year payback periods. We could still make some money on fees, but the deals need to be a little larger. And, Illinois is sort of building some new incentives now that we're excited about. Connecticut has a decent incentive program. Maryland has a new community solar program that a lot of the affordable housing owners are interested in. There's some carve-outs for affordable. And then North Carolina has kind of been a long time good market for more smaller kind of utility scale projects and stuff. Next. So I'm just wrapping up here. So, this is just a little bit of how NHT-Renewable and Enterprise can help. We could, if you were interested, we've been working, as in our work with a lot of the housing owners, a lot of people contact me and they want to know, can you help me understand the different options, what could fit on my rooftops, what options would make sense based on, our risk tolerance. And, if you're serious about developing a project, we could talk about maybe co-development or some type of partnership. We're happy to even talk about owning projects if doesn't seem like a good fit for you all, but seems like a good project. And we will bring, so through Enterprise, bring debt. And then we have relationships with several different solar tax investors that can bring the equity to the deals. Next. So I think that's it for me. This is my info. And then, Bettina, you're going to have our info at the end, right?
I sure will. Yep. And these, as a reminder for folks who maybe want to dive into those financials a bit more, take a closer look. These slides will be posted online and sent out afterward, so you can check those out.
Great.
So thanks so much, Jared. Really appreciate that. And we will now turn it over to Esther at Enterprise.
Okay, great. Hi, this is Esther Toporowski. I'm a Senior Program Director with Enterprise Community Partners. I'm on our National Initiatives team, and I work mainly on a lot of our sort of green financing solutions. And next slide, Bettina. So just for folks that don't know, Enterprise Community Partners, we've been around about 30 years, and our mission is to really improve communities and people's lives by making well-designed homes affordable. And we bring together sort of a nationwide know-how, partners across the country, work on a lot of policy leadership, and really investment to multiply the impact of local affordable housing development across the country. Next slide. And so this is just, I'm going to kind of breeze through these really quickly. It's just a little background about, that we've been in the sort of green financing space for quite some time, about a decade now, and we've worked on, we've invested quite a bit on the capital side and through our program and policy work. And I think we've learned a lot to date. And so, the reason we're pretty excited about this portfolio model that National Housing Trust Enterprise created was because I feel like we were working a lot in the energy sphere and space. And there were a lot of challenges with sort of add-on financing, with refinancing maybe being the only sort of sweet spot for folks. And so for us, looking at this model and sort of kind of hand in glove with National Housing Trust, we saw that the portfolio level can lead to more investment in the sector. Smaller scale properties can do a bit more, and it's a lot easier on obviously a debt and sort of equity side with this structure to make it work. Next slide, please. So Jared already went over, I think this case study a little bit, but just wanted to highlight this because this was the first deal that we did together. We came in on the debt side, and this was, just a great project to kind of start out with when the model was sort of getting going. We had some sort of generous lending capital from Bank of America through their energy efficiency finance program and some grant money to kind of go in on this. And it was the NHT-Renewable, the DC5 deal. And this is a deal in Washington, D.C. that Jared just mentioned on the sort of 5 properties, 340 units, and they did installation of PV and solar thermal. So this was sort of our sort of first foray, into this sphere and looking at this model. And so I'm going to give a little bit more of a perspective of, what it took us to sort of get across that line to be comfortable from the Enterprise Community Loan Fund perspective. Next slide. So, we really like this because it aligns with our mission at Enterprise when we put our preservation hat on, right? So when you look at this structure, it really acts like a traditional flip LIHTC GPLP structure, right? The first deal that we did, and it was a structure that we're familiar with. It looks a lot like you're doing, a LIHTC deal, but it's also mission aligned because it creates income for our partners, right? For purposes of sort of reinvesting back into portfolios for preservation or for services or for capital upgrades or for health upgrades or for other energy efficiency upgrades. So, the structure that Jared went over, the traditional flip structure, there's a partnership, right? Partner ownership of the PV equipment, and the ITC investors in there for a 5-year period. And the traditional flip after 5 years, then it goes back to the sponsor, in this case, National Housing Trust. And then after that, National Housing Trust is, gaining all of the benefits from the income. In particular, in DC, there's income coming from solar renewable energy credits and also energy income that's coming from the power purchase agreements on the 5 properties. And the financing for us was really nice because it occurs across a portfolio, right? And so the benefits, again, like Jared outlined, is a sort of revenue that's coming into the property owner, obviously decreased operating expenses. And a big one is also it's less costly, right? If you're doing a bunch of stuff at the same time, especially on the financing side. And if you're developing multiple sites, you get reduced pricing on systems. So there's a lot of benefits there. And then the roles that Jared went over, there's the project development, technical assistance, and origination, and providing sort of the debt and equity. So National Housing Trust has come in with an equity provider. We can come in on the debt side, and then NHT's team has been phenomenal. They've developed since sort of early days. It's kind of amazing how streamlined the system is now, just really understanding the kind of soup to nuts, their development team, and being able to kind of walk folks through the process. So how it usually works is, we're talking to partners, people that are interested in solar. We sort of bring in National Housing Trust expertise, and they say, here's what you could do. What does your portfolio look like? We could do that quick desktop analysis and scan to look at what that opportunity is. They've developed a really nice model that we're very comfortable with from the lender perspective, because it really looks like a real estate pro forma, and they can kind of put those assumptions and numbers in, and it comes back, and you can really look at it and see what the opportunity is, and they can really walk you through the process step by step to just really kind of showcase how it may work for you and what the benefits or what the returns would be, and what would be sort of helpful for your portfolio. So that's really helpful for us to kind of get that initial screening and moving along, and then seeing what that sort of, debt opportunity is as well. Next slide. So this is, again, Jared had a really nice, I think, simplified version of this. And this looks a lot like, obviously this kind of LIHTC structure, but again, it's working with the housing owner. They're creating a special purpose entity, in this case, some sort of renewable LLC. And you're going to hear from Chris after me. They created Denver Housing Authority, their own special purpose entity. And so we work with Denver Housing Authority, National Housing Trust. We did a participation loan with NHT-CDF with Link Housing in California. And then we also did, outside of this DC5 deal, we did another with Channel Renewable with National Housing Trust. We've closed on a few deals now, and they're all really quite successful in using this exact same structure. So the sources coming in, you're looking at ITC equity at 30%, and then roughly 50 to 60% debt. And if you're in pretty strong markets, you have SRECs, you have rebates, you have grants, that kind of thing. And on the other end of and then the host sites are the properties. Those could be multiple properties. In this case, it was 5 properties with the DC5 deal. And the players, you have a project sponsor, the affordable housing owner, and then you have a third-party solar installer and a third-party solar maintenance to do the O&M to make sure that things are obviously performing kind of an ongoing basis. So it's pretty simplified and something that's pretty easy to understand from our perspective as a lender. Next slide, please. And this is just to simplify the kind of uses, the sort of sources and uses, right? So hard costs, like Jared said, it's about 1.2, maybe 1.3, and there's some soft costs in there. Again, we came in on the debt side as about 55%, 30% ITC, and then some sponsor equity or sometimes grants, that kind of thing. So it's pretty simple. And next slide, please.
Esther, I'm actually going to jump in here, use my unmuted prerogative, and ask a question. You mentioned Enterprise's approach to using efficiency for preservation reasons, and I have a question here about if savings are passed through to tenants through lower rents, and I wonder if you could just comment on that.
Mm-hmm. Yeah, no, it's a good question. I think sort of similar to the other question that Jared answered. Yeah, so I mean, you can decide with this structure how to utilize that income that's sort of generated, right, back to you. You can, I know with Link Housing, they decided to provide essentially zero energy bills to their tenants by providing a credit. So the nice thing about this structure is it really is, a way where you can, as an organization, decide to utilize that extra income that you're getting, right? And if you are doing something on a sort of master meter basis, then you can utilize that extra income to provide 100% credits to your tenants. Okay, so next slide, terms that we put out for this loan to National Housing Trust. A loan amount was $730,000 on the $1.3 million. It's a 10-year term, 5.5 rate. The security that we felt comfortable with was a UCC lien on the solar equipment and sponsor guarantee from NHT, and then a debt service coverage at 1.2 for a little cushion there. Next slide. I'm going to try to breeze through these. Just to look at what an operating pro forma looks like on the cash flow side. So again, for us, looking at the income, what are those line items? The sale of the solar renewable energy credits is unique to DC. There's other markets with SRECs. The SRECs in DC happen to be quite robust. We had to really look at this source of income as a new way of getting income, and how secure is that? But I'll go into that a little bit later. And the other line item is the sale of electricity to a property. So that's through the power purchase agreements to the host site. So those two sources right there are getting your total income, and the expenses are kind of sort of go without saying, pretty basic for maintenance, insurance, tax, and audits. And then you see the debt service coverage is actually quite healthy. It's well above 1.2. And then the net cash flow, you look at the sort of preferred return back to the investor for the 5-year period, and then there's a sort of cash flow back to NHT Solar Management. Next slide. Okay, so I'm going to talk about underwriting considerations because I think some of the lenders on the call might be interested in how we sort of are looking at these things. So I think one of the first things we looked at was security, right? How do you secure and value the solar equipment? So everyone knows you kind of got to look at collateral. So, if it's not secured by the real estate, we thought, okay, so what is security going to look like to us? And again, we're talking about this from the perspective of kind of doing our first deal on this kind of project. So we did a security through a UCC lien on the equipment, and additionally had it guaranteed by the sponsor. And so we thought it was important to also have some level of recourse, about 50% minimum. In addition, we thought it was important to have some sort of developer equity investment in the deal, 5 to 10%, to show that they kind of had skin in the game. And I'll go down to valuation. So usually loan to value is directly tied to real estate, at least in our sort of sphere and world as a houser. But in this case, you need to look at really the value of the solar equipment's useful life against the loan. So it's essentially an asset with a declining value over time. And one way to do this on our end was to calculate the net present value of the upfront cash flow stream over the term of the loan itself, along with the total loan, to ultimately calculate the total coverage, right? So it's important for the lender to have all necessary rights and pledges to the equipment, so that if needed to enforce those rights, it would be easier kind of to enforce. So those are just some kind of things that we looked at in terms of valuation. And then kind of stress testing, sort of to ensure that that the cash flow was going to materialize. That was something else that we wanted to look into. So because it's considered a cash flow loan, solar, so it's important to understand how it's produced and whether it will materialize. And one way to work this out is ensure that we thought, at least, to structure it, the front end was that the lender gets paid after sort of immediate expenses. So when you look at the pro forma before, there's kind of a management fee, there's preferred returns. So if those things could come after the lender is paid to ensure some level of security, so income minus fixed expenses, and then lender gets paid sort of immediately, so we can kind of stay above the sort of the top of the line to kind of meet what we need to feel comfortable. Next slide. So repayment. So how is cash flow produced, and how to guarantee your payment stream? That's obviously a big one coming from a lender. Want to make sure that the stuff is sort of materializing. So on the income side, the primary repayment, like I said before, is from solar renewable energy credits in this case, and the PPA contracts, which is the energy income. And it's really important to review the SREC contract and the PPA to be comfortable with the income stream. So it comes directly from payments for energy from the 5 NHT properties. So the properties guarantee the purchase of the power for a certain rate in a certain term, as well as the sale of the solar renewable energy credits to the utility for a set price and term. So that's how this particular deal works. We felt very comfortable with that and reviewing that, and worked, of course, back and forth with NHT and their sort of expertise in this area. And on the production side, is this thing gonna perform? So the income source relies on the equipment performing as expected and the counterparty performing as guaranteed and sort of agreed. And so this is all just ways to sort of mitigate risk, right? We know where the income is coming from. Okay, so if it's reliant on the performance of the system, then we have to sort of ensure that that's happening. So commissioning from a third party to ensure it's built as designed, kind of just like rent comps for income. It's really sort of the same thing. And so we also looked at performance guarantee from the installer to ensure production of the system obviously performed as well as it should, and then equipment warranties and the replacement reserve as well, to help ensure that the energy output from the anticipated life of the project was going to materialize. And then in addition, you need to ensure that the counterparty or the solar installer is experienced and pretty reputable in the industry. So that's just something that you kind of look into when you're looking at the underwriting, to get a good idea, to make sure that sort of installer isn't going to sort of go bust and not be there in a few years. To try to blow through this, the debt service coverage in the event the energy generation falls short, we wanted a healthy kind of minimum 1.2. And evaluation, I'm looking at the time, so I'm going to try to be quick. You need to ensure the PPA and SREC contracts have appropriate approvals to operate over the term of the loan, as well as approvals from sort of investors and lenders, which is a pretty big deal. And I would say next slide, just to make sure we bust through. So again, we want to really look at the organizational risk, how to assess the sponsor, as a guarantor of this, if you're looking at the system with this particular structure. So You need to look into how financially stable, as you usually would. I mean, it's just like underwriting any other loan, really, and what kind of liquidity they have and a strong balance sheet. And for us, it's important if you're mission aligned to preserve and improve affordable housing. And is there history working with the sponsor? In this case, we had done quite a bit of syndication with NHT's portfolio. I felt very comfortable working with them and very comfortable with the fact that the structure they're creating is 100% emission aligned. Next slide. So, this is just to say that the performance for this first deal, like you saw in Jared's presentation in 2014, we're really seeing that the initial projections versus the actual returns are really quite lovely, that they're way outperforming what I think was just sort of initially and conservatively projected. So as a lender, we're extremely happy with the outcomes and have moved forward and closed on some loans with a few more deals. And so it's been quite a success story for us. And that's my information if you guys have any more questions.
Excellent. Thanks so much, Esther. I think we won't have much of a Q&A at the end of this, so I do want to just pop one question over to you from our colleague, JJ Froelich, who is wondering if you can confirm his understanding that this model only works in states where third-party sales and or solar leasing is allowed. Is that your understanding as well?
Yes. Yeah.
Okay.
Great.
Thank you.
We're effectively leasing on top of our own properties.
Yep.
So.
It has to be allowed, that's right.
All right. Well, that's all I'll say, and we'll go over to Chris in Denver.
Great. Well, again, Chris Jedd with the Denver Housing Authority. Before we get started, a brief overview of DHA. We're a quasi-municipal corporation with a portfolio of over 11,000 units throughout the city and county of Denver, serving about 26,000 very low-income and middle-income individuals around the city. The portfolio mix, which really ties into how we approach solar, is we have a lot of elevated structure, mid-rise buildings, 10 to 12-story senior buildings. We have row homes, garden-style apartments, as well as dispersed single-family homes, about 1,000 single-family homes peppered across the city. So definitely a diverse portfolio. Next slide, please. Regarding solar, it looks like my pie graph here got jumbled in the translation here, but that pie graph represents DHA's demand for electricity, and the large portion of that pie is what we buy from the grid right now that is not renewable. And the other sectors are that purple portion on the right-hand side. And this actually goes to Jared's point of different ways you can finance and purchase solar. The purple portion there is a 2.5 megawatt power purchase agreement, which is what Jared talked about. We partnered with another developer, and they put the solar panels on our rooftops, and we have a long-term power purchase agreement. So it works good. Jared touched on the pros and cons, so I'm going to move on from that. That small blue sliver up there, that's just rooftop mounted solar that we financed with construction loans and debt, and that's approximately about 1 megawatt across the portfolio. And then that lighter green portion on the upper right there, that's the solar garden that we're talking about here, and that just came online in end of last year, 2017. So challenges with solar, one is suitable roof space. Right now, DHA, I mentioned we have about 11,000 units. We've pretty much maximized all the viable roof space, depending on the roof condition. If there's shading, if we're going to redevelop the property, we certainly want to invest in solar assets on the property. Various property types and ownership structures. DHA, we have public housing. We have 100% LIHTC buildings. We have project-based Section 8. We have Section 8. So there's a lot of different buckets of affordable housing, and some of those buckets are intermingled into 1 meter, behind 1 meter. And then financing obviously is a challenge, as well as the utility, who pays the utilities and utility allowances. And in DHA's scenario, we pay the majority of the utilities for our residents, which makes it pretty advantageous for renewable energy investment as well as energy efficiency investment. Next slide, please. So that said, community solar, and this is really similar to what Jared's model and Esther's model is in terms of creating a separate project company to develop a special purpose entity to develop a solar asset. It's a little different from what we heard earlier today, and as community solar. And if you boil it down to its bare definition, community solar is really an array of solar panels that is shared by multiple buildings or multiple meters. It could be, it could be an acre, it could be 10 acres, it could be 500 acres, it could be, real small rooftop. But the idea is that multiple buildings and multiple meters share it. Why DHA went to community solar is really we ran out of viable roof space. Out of all those units, we maximized the roof space, and for us to pursue our mission of being a sustainable housing authority, we had to continue. So the next step was to look off-site. Next slide, please. Community solar, just basics about it. Like Jared said, just like any solar program, each state varies. The majority of states now, I believe, don't have community solar policies, but we're fortunate in Colorado and a lot of states on the East Coast have it too, and California is rolling out with them. Various models and approaches, which is what Jared spoke about. Virtual net metering we'll get into in a little bit, and then the next one is various ways to participate. And this is kind of to Jared's point earlier. Is one option in community solar is there's community solar developers out there, just like building developers. So you can just buy into a community solar and give them equity or give them money, and then you own that portion of that solar garden. So whatever that portion is, whatever it's 10%, 20%, you get that electricity that goes from the solar garden to your meter. Pros and cons of that. The con, obviously, for DHA is that we don't have a bunch of upfront money. We can just buy into that. Next one is a power purchase agreement, which is where you partner with a developer, and with that developer, you enter into a long-term 15 to 20-year contract to buy the power from them over the next 20 years. So then that's what DHA did with our 2.5 megawatt power purchase agreement I talked about earlier in that pie graph. And then the third one is to develop your own. And so, I think that the benefits of developing your own, or what Jared and Esther mentioned, is, developers take a developer fee, there's margins. And so if you do it your own, you can keep that money in-house. You can drive that into deeper savings. You can drive it into tighter budgets, and it just made more sense. And for DHA, we have a real estate development team, and like Esther mentioned in her performa, the performa is similar to a real estate deal in a building. You got to have land, you have operating expenses, revenue. So the thought is, if DHA can develop low-income housing tax credit properties with equity investors, and hey, let's try to do this with the solar model. So that's the decision we made. The benefits obviously are renewable energy, predictable energy costs, and savings. The challenges were, well, we can get into the challenges here shortly. Bettina, do we have a hard stop at 2, or what? Should we just? I know you mentioned.
Yeah, thanks for saying that. I do want to acknowledge that we're at the hour, and we have had a lot of really interesting questions come in from our colleagues we know, as well as a bunch of new folks, which is great to see. I just want to say, if people do have to jump, that we will, I'll make sure to get those questions to our speakers so that you get an answer. But I really appreciate, Chris, you're staying with us, and Esther and Jared as well, if you can. We'll just get to the end of your presentation, Chris, and follow up with questions afterward.
Yeah,
if that's
I'm happy.
you.
Yep. Yeah, no, that's great. I just didn't know how fast I had. Okay, excellent.
Yeah. No, there's a lot to say, and we want to hear what you have to say. So, yeah, thanks a lot.
So next slide, please. So that said, with that mission in line, DHA, our team, our board, our executive leadership team, they said, hey, let's develop our own solar garden. We can keep the money in house. We can build a better mousetrap. It provides us flexibility. We don't have we can transfer power purchase agreements to different buildings. And so this slide right here kind of speaks to the highlights of the solar garden. Briefly, it's located in Watkins, Colorado, which is just south of the Denver International Airport. It's the first housing authority developed, owned, and operated community solar garden out there. It's dedicated to 100% low-income residents, so it can't be subscribed to, other buildings or support buildings. It has to be low-income multifamily buildings or single-family. So these are kind of some of the statistics around it. Next slide, please. So project team, I just want to, this highlights all the partners involved. DHA was the developer and sponsor of the program. Space Solar, they were the EPC, or engineering, procurement, and contracting. It's pretty much a general contractor for the project. SolarTech, it was a site host. The project itself was 10 acres of land, and we ended up having a lease for 20 years on that land. And SolarTech is the lease, or the owner of that land, so they're our partner for the land. Grid Alternatives is a nonprofit, and they were involved with the project management as well as the workforce development arm. We did a pretty robust workforce development with DHA residents and other residents around the city and county of Denver. Insight Energy, they were a technical consultant, and then NHT, obviously, they were instrumental in the financing. Enterprise was the debt provider for this. Balanced Spar was counsel, and then Monarch Private Capital was the investment tax credit partner for it. So, next slide, please. So this slide kind of demonstrates how the mechanics of it work. And in the upper right is Xcel Energy, our utility, and like I said, it's not available in every state, but Xcel has a solar rewards program, which is their community solar program. And basically what happens is they issue an RFP for developers, solar developers, in this case DHA, to build these. And in return, they produce renewable energy credits, or sometimes called SRECs. And so in the lower right, that's the DHA Solar Garden, or that's the special purpose energy, DHA Solar. And the left side of the screen is that's one of our buildings in Denver, one of the subscribers. And so the arrows you can see, if you start with the Solar Garden produces energy, and we feed it into the grid and send it to Xcel. And so in return, Xcel Energy gives us renewable energy credits. So, every kilowatt hour we get renewable energy credits. In return, Xcel feeds the energy to Syracuse Plaza, the subscriber of the Solar Garden. Syracuse still pays the bills for Xcel, so they still pay Xcel Energy. But Xcel also says, hey, Syracuse Plaza, you're a subscriber to the Solar Garden, so we're going to give you a credit on your bill. And we'll say the credit's 5 cents a kilowatt hour. So for every kilowatt hour the subscriber gets from the Solar Garden, they get a 5-cent credit. So the Syracuse Plaza subscriber wins out, because now they get 5 cents credit on their bill for every kilowatt. They love it. In return for that, they pay DHA Solar Garden a fee for that credit. So let's say the credit's 3 cents a kilowatt hour. So they get a 5-cent credit from Xcel, and then they pay DHA Solar Garden 3 cents. So the effective savings is 2 cents per kilowatt hour. And this model, it varies slightly depending on what state you're in, but in Colorado, this is the only way Xcel, this is the policy. So that you're paying, like Jared said, you're paying 2 bills, which is kind of unfortunate right now, because it does add some complications to it. But in the end of the day, this is the cycle of the bill credit, the electricity, and who pays what. Next slide, please. Ownership and org chart. So this speaks to the financing and the investors, and we'll start from the top. Denver Metro Solar is the special purpose entity that owns the Solar Garden out in Aurora. And then, similar to a LIHTC partnership or a GP-LP deal, there's the general partner, and then the equity investor as the limited partner, and you have the flip. And it worked out really well, because DHA, our team and our board, we're used to LIHTC deals and low-income housing tax credit deals. And although there's differences, there's the flip and the partnership and the GP and the LP were the same. So it gave everyone a level of comfort of understanding, and it definitely made it easier for board presentations and getting this approved. So yeah, DHA is Denver Affordable Energy was formed to manage Denver Metro Solar, and then DHA is one of the members of that. So, and then at the end of 6 years, that would flip over, and DHA would be the main partner. Next slide, please. The economics of it. So the overall total development cost was $3.8 million. And you can see the breakout there. We had $1.2 million from the tax equity investor, Monarch. Enterprise Community Loan Fund brought the $2.4 million, and it was just a 15-year fully amortized loan for that. And then DHA put in equity and a subordinate loan of about $200,000, so they equal at 3.8. And it's important to note, we also were thinking about, when financing this, we were a little had a little trepidation on this in terms of, is the tax credit is the juice worth the squeeze getting that tax credit, like Jared said? Is it big enough? Is it too small? So we actually reached out to lenders. We did 2 requests for proposals. One was for this model, and the other one was for just 100%, just debt model. And the good news is both worked. We could have got this project done with the debt, but the equity model was definitely more advantageous for everyone involved. So, which kind of mirrors what Jared and Esther were saying. So it definitely works at this scale, which is really good. So that's how the financing broke out. Denver Metro Solar, it's just like a building performer where you get rent revenues. This doesn't get rent revenues, but it gets 2 forms of revenues, and which just speaks to that previous slide we were on. One is the renewable energy credits from Xcel Energy, and that accounts for approximately 53% of the revenue from Denver Metro Solar. And then the other stream is the sale of electricity to the properties. So, and that's about 50 or 47%. So both of those revenues were looked at for the underwriting, as to Esther's point, and the lenders and the investors wanted to make sure those were consistent and predictable and underwritten. So, and then after the revenue, the annual expenses, similar again to a building or a real estate deal. You have debt service. In this case, we lease land. We have a third-party operations and maintenance contract. There's a management fee, and then as well as replacement reserves. And if you look at that picture, that's you can see that's the solar garden in the upper right-hand corner, and it's just due east of Denver, about 30 miles outside of town. So, next slide, please. So results. It took probably from the time we decided to do this to interconnect about 20 to 18 months to do with all the procurement. The project was interconnected in December of 2017, and so it's really just taking off. It's fully subscribed. So basically what Denver Metro Solar subscribes to low-income housing buildings in the Denver metro area. Majority of them are DHA buildings, but we are partnered with other housing authorities, other housing developers. So it's not just a DHA model. We're the general partner, but we share this with other housing authorities in the Denver metro area that have PPAs with us or power purchase agreements. So result is reduction of operating expenses. It's probably right around 20% of your electrical bill can be reduced. It aligns with our mission, the City of Denver's mission of producing clean renewable energy. Being the developer allows a lot of flexibility. If DHA wants to switch subscribers, move buildings around, make a building net zero, we'll say, we could tie it to this solar garden, which is real nice. Another result that isn't on here, but operations and maintenance. Since they're off-site, it makes it a lot. Solar panels don't really require a lot of operations and maintenance as is, but it's nice that they're off the roofs and off-site, and we have a third party doing that, so it doesn't impact our typical O&M team. And 2 other ones is bill savings to low-income residents. As I mentioned before, we pay the utilities for the majority of our properties, but there's a portion of this solar garden that was carved out to give to low-income residents that do pay their utilities. So there's a 5% of this goes to DHA residents that pay utilities, so they get that direct bill credit for free. So they don't have a power purchase agreement with DHA. They just get that credit. So that equates to about $15 to $20 a month per resident of savings, which is great. And then lastly was workforce development. We had several DHA DHA residents, as well as other residents around Denver that worked in some training programs and got some jobs out of the deal. So next slide, please. I think that may be it. Yeah, so that's kind of a quick overview of the project as it is today.
Awesome. Thank you so much, Chris. That is a lot of information, a lot of great information from all of our presenters, and just based on the fact that it is 1/4 and nearly all of our attendees have stuck with us here until the very end, and just based on the number of questions, it really indicates the level of interest in this model and in the space generally. So that's really great to see. I will make sure that all of the questions that weren't answered do get to our speakers, and so you get answers to those. But I will have to end it here. Like I said, we're quarter past. So I just want to thank everyone for tuning in to this SALN webinar. And a huge thanks to Jared, Esther, and Chris for sharing your insights with us today.
So Bettina, if you'd like, you could send us who asked the question, and
yes,
we can get back to them directly if you'd like.
Yep, absolutely, we'll do that. And everyone look out for an email with a recording of this webinar as well as the slides so you can really dig into those financials, and also keep an eye out for more information on that SALN resource hub that I mentioned. So that being said, thanks a lot, everyone, and I hope you have a great rest of your days.
Thank you.
Great, thank you.